Welcome to another deep dive. Today, today we're going to be looking at what happens when artificial intelligence meets Wall Street. Specifically, we're going to explore how the release of a brand new Chinese AI model called DeepSeek, well, it sent shockwaves through the tech sector, triggering a sudden sell-off. Our guide for this fascinating journey is an article by Lucas Downey from appsignals.com. It's titled "DeepSeek Fears Revealed the Weak Hands." And it was published just a few days ago on January 30th, 2025. So we'll unpack what happened, why it matters, and what lessons you can glean from this market shakeup.
It's amazing to see AI making waves, not just in the tech world, but in the financial markets too. This situation really highlights how reactions, rather than in-depth analysis, can sometimes drive investment decisions.
Exactly. The article describes how DeepSeek's arrival spooked some investors, causing them to dump tech stocks and sending prices tumbling. The VanEck Semiconductor ETF, or SMH, took a nearly 10% hit in just one day. For those of you who might be unfamiliar, an ETF, or exchange-traded fund, is basically a basket of stocks that you can invest in. So in this case, SMH tracks a bunch of semiconductor companies. And get this, even a tech giant like NVIDIA, the ticker symbol NVDA, saw its stock price plummet by a whopping 17%.
Now, that's a significant drop, and it really shows the scale of the initial fear that DeepSeek generated. Downey refers to these skittish investors as weak hands, those who panic and sell at the first sign of trouble, often locking in losses. Think about it. Have you ever felt that urge to hit the sell button when things get a bit shaky? That fear of missing out, or FOMO, can be a powerful motivator.
It definitely can. But here's where it gets really interesting. While some investors were scrambling to get out of tech, there was another group, often called institutional investors, or the smart money. They were doing the exact opposite.
Precisely. And the article highlights this contrast beautifully using something called the Big Money Index, or BMI for short. The BMI tracks the actions of these institutional investors. Think big pension funds, hedge funds, those kinds of players. It's a way of gauging what the smart money is doing. And what's fascinating here is that while the weak hands were selling, the BMI was actually climbing. It surged 14 points in just 2 weeks, from 37% to 51%. That indicates a strong vote of confidence from those who, let's face it, usually have access to more information and often take a longer-term view of the market.
So while some were panicking, the pros were seeing a buying opportunity. But wouldn't that be risky, especially with a potentially disruptive force like DeepSeek entering the scene?
That's a great question. And it's important to remember that no investment strategy is foolproof. But following the smart money can be insightful. Institutional investors often have teams of analysts and researchers, access to proprietary data, and they're looking for trends and opportunities that most individual investors might miss. It's not about blindly copying them, but understanding their rationale can be valuable.
So it's like having a peek at the playbook of those who play the market for a living. But where did all this money go? The article mentions that money doesn't just disappear, it rotates.
That's a key concept to grasp. When some investors sell, that money doesn't evaporate. It flows into other assets, in this case. While some money left the tech sector, a lot of it was simply reallocated. And a deeper look reveals some fascinating insights into where the institutional investors were focusing their attention.
Okay, now I'm really curious. Let's dive into where that smart money went, shall we?
You might assume that with all the DeepSeek fears, institutional investors would have completely abandoned the tech sector. But surprisingly, that's not what happened. In fact, technology still attracted 22% of the inflow from these savvy investors.
So even with this new AI on the scene, they weren't ready to give up on tech entirely. That's pretty reassuring for anyone who, like me, has a chunk of their savings in tech-focused investments. But what about the rest of that smart money? Where did it land?
The map signals analysis points to two other sectors that caught the eye of institutional investors. Healthcare snagged 19% of the investment, and consumer discretionary came in close behind at 17%. They even included a pie chart in the article to visually represent this breakdown, which really helps to see the flow of movement.
Pie chart. Excellent. I always appreciate a good visual. But healthcare and consumer discretionary, that's interesting. What do you think is driving that? Why are these big players so interested in those sectors?
Well, it's important to remember that correlation doesn't equal causation. Just because these investors are buying into these sectors doesn't mean they know something we don't. But it does make you wonder what they're seeing. Perhaps they believe that regardless of how AI develops, people will always need healthcare, and they'll always want those goods and services that fall under the consumer discretionary umbrella.
That's a great point.
Yeah.
It seems like even with AI potentially disrupting various industries,
Hmm.
there are certain sectors that remain relatively stable and attractive to long-term investors. It really highlights the importance of looking beyond the headlines and not just reacting to the latest news, doesn't it?
Absolutely. It's about understanding the underlying trends, the long-term forces that shape the market, and not getting swept up in the day-to-day noise. Remember, sometimes what appears to be a major shift, like the DeepSeek sell-off, is actually a more nuanced reallocation of resources by those who are looking for the best opportunities.
So this DeepSeek saga isn't just about a new AI shaking things up. It's a case study in how different types of investors react to market events. But let's bring it back to our listeners. What's the key takeaway for those of us who may not have a team of analysts at our disposal? How can we apply these insights to our own investment decisions?
The key takeaway, in
Right.
my opinion, is this. Even amidst uncertainty and volatility, there are always opportunities. The trick is to avoid becoming a weak hand ourselves, and instead try to adopt a more informed and strategic approach. Think back to what we discussed earlier about the smart money and the BMI. They didn't panic when the market dipped. They saw it as a chance to buy assets they believed were now undervalued.
So it's not just about avoiding losses, but also about potentially finding opportunities that others might miss due to fear or short-sightedness.
That's what
That's a
it is.
powerful way to look at it.
That makes a lot of sense. And it brings to mind something we haven't explicitly addressed yet. We've talked about weekends in the context of investing, but how often do you think we fall into that same trap in other areas of life? That's a fantastic point. It's so easy to let fear or uncertainty kind of dictate our decisions, whether it's a sudden market dip or a setback in our careers. But just like in investing, taking a moment to pause, gather information, and assess the situation objectively can lead to better outcomes.
So it's about recognizing those moments when we're about to become a weak hand and instead choosing a more thoughtful
Hmm.
and strategic approach. It's almost like training our minds to see challenges as potential opportunities for growth.
Exactly. Imagine you're facing a difficult decision at work. Perhaps there's a new project that seems daunting, or you're considering a career change that feels risky. It's natural to hesitate, to let those weak hand instincts kick in.
Hmm.
But what if, instead of shying away, you approach it with the same mindset as those institutional investors? You do your research, you analyze the potential risks and rewards, and you make a decision based on a clear understanding of the situation, not just fear.
It's like that old saying, feel the fear and do it anyway.
Hmm.
But in this case, it's more about acknowledging the fear,
Hmm.
understanding its source, and then uh, choosing a course of action based on careful consideration, not just emotional reaction.
Precisely. And the beauty of this approach is that it applies not just to investing, but to so many aspects of life, whether it's a personal relationship,
Mm.
a creative endeavor,
Yeah.
or even just navigating the ups and downs of daily life. That ability to step back, analyze the situation, and make a conscious choice rather than a reactive one can be incredibly empowering.
It's like we're taking those lessons from the world of finance and applying them to our own personal growth. We're becoming more mindful, more strategic, and ultimately more in control of our own destinies.
And who knew that a deep dive into the world of AI and stock market reactions would lead us to such profound insights about ourselves? It's a reminder that learning can come from the most unexpected places.
Absolutely. So to wrap things up, remember, the next time you find yourself facing a challenge or a moment of uncertainty, ask yourself, am I about to become a weak hand? Or am I going to use this as an opportunity to learn, grow, and make a conscious, informed choice?
And remember, even the most successful investors make mistakes. The key is to learn from them and keep striving to make better decisions.
Well said. Thank you so much for joining us on this deep dive. We hope you found it insightful and, dare we say,
Right.
even a little bit transformative. Until next time, stay curious, stay informed, and don't let those weak hands hold you back from reaching your full potential.